The COVID pandemic has brought about market fluctuations that have enabled people to make lots of money both on the way up and on the way down. But we're now in a period where we've got this bear market rally. And the big question is, how much longer is it going to last? Let's catch up now from a technical point of view with Ron William from RW Advisory. Ron, welcome. It's good to be able to catch up with you again and ask you the question about these markets and how much longer can we expect the upside before? I know we've spoken about before the potential downside that you're saying is coming at some point. Give us an update on where you see things at the moment.
Great to be back having this discussion from when we last did in March while I was in Singapore trying to make my way to the UK. And as we look at the markets now, last week there was a warning shot across the bows just as the equity market, S&P 500 in particular, failed to push above the pandemic price gap. I believe that was between 32.60 and 33.30. You can see there the red box on the chart. And so there's certainly a mixture of pressures in the market, technical, seasonal, and political. And the technical side, one out of the three, is both in price and time terms. You can see there there's a cycle overlay just highlighting that we have a few important cycles that are coming through, which are likely to add a little bit of disruption at a time when we've completed this potential five-wave price formation into the pandemic gap at 32.60, 33.30. That retracement is a record retracement of about 76.8, 78.6, which is a mathematical zone that a lot of traders will be watching. But essentially, it's part of this V-shaped recovery, suggesting that we will at least hit an exhaustion point and fail to break above the record highs of this year in 2020.
But there's something we've got to talk about, and that is, of course, is the potential disruptor to this, and that is the political that you mentioned, actually, is one of the things that we should be looking at. And of course, the US elections, how does this play into where we are and where the markets could go?
Yes, so technicals we've just covered, and certainly a move back below the 3,000 psychological level, and then 2,800, the 50% make or break quantum level will be key. That'll be the technical side of things. But then seasonal, we are hitting the peak period, the midsummer rally of July, which happens on average even during a pandemic, more so when the market's on the up in this V-shaped recovery. But actually, the on average peaks carve out in the month of August, setting up for the full crash cycle of September and October. And this is when you test out over 100 years worth of data, which includes presidential elections. Now, if you just focus on the presidential election part, within the 4-month period leading to any US presidential election, on average, statistically, the markets are down 10%. Particularly if that existing presidential leader is losing popularity in the polls. And we do have a lot of leading broad data suggesting that, of course, look at the situation with COVID-19, the economic shutdown, and now the protests which have been ongoing and adding further pressure in the US markets and also producing echo events across the world. It is painting a high pressure situation technically, seasonally, and politically. So the political statistics suggest further downside pressure to come.
Let's move on and take a look at another chart that I want to bring up, which I'm interested in. Again, we've spoken about this before, and that is this roadmap of the investment cycle. Whereabouts are we at the moment on this pattern that we've got developing? We love patterns in technical analysis, and I know that you are a great one for following patterns and momentum cycles and so forth. On this chart, where are we?
Yes, so we're between the WXY zone. This roadmap was originally developed by Mr. Robin Griffiths, who basically developed and used it for over 50 years. And the idea is that markets move in a sine wave. It doesn't move up in a straight line. There's always extreme cyclicality to the move. And so on the way up, it's fueled by greed. On the way down, it's weighed down by fear. Fear is greater than hope in terms of the emotional weight. And so for that reason, the downside is that much more sharper than the upside. The issue here is that between X and Y, this is the bear market rally just before we get the potential big move down. And this usually follows the shape of a roadmap where we get a fall, the initial crash, then a rally, that's the bear market rally, followed by the rest of the fall. So if we look at the NASDAQ market, that has actually already tested its record high of this year, but there's been a non-confirmation if you look at the Dow Jones Index or the S&P 500, which is a more broader-based measure. And then looking at the rest of the world, certainly many of these world markets are still below their historic peaks. And from a long-term cycle perspective, the roadmap I just showed there on the screen is based on a 10-year cycle. So we've already broken that 10-year cycle in price and time terms. And so the big bull's back is likely broken based upon the last discussions we've had, and still needs further time to recover. The average time is usually anything from 1.5 to 3 years, and we've fallen way short of that. So this isn't an event. It is a three-stage process, part of that bear market roadmap: fall, rally, and rest of fall. And the idea, the key message here is not to get fooled by that false hope rally, which has been very impressive, but may still have a lot of strong downside pressure from the second half of this year onwards into the US elections.
Yeah, just picking up on a point there, you mentioned about the NASDAQ, the Dow and the S&P. Going back to good old Dow theory, Charles Dow, the original grandfather, if you like, of technical analysis, he liked to see things moving together. As you rightly say, we haven't had a new record high for the Dow or the S&P, but we have for the tech-heavy NASDAQ. Now, the fact its technology may be significant, I don't know, but on that idea of Dow theory, if we were to get a record high in tandem with the NASDAQ for the Dow and the S&P, to what degree would that push out your theory that we are going to get more downside more immediately?
It would certainly put it on hold and trigger a reassessment of the downside view. I, for one, would be kind of optimistic if and when that were to happen. Having said that, there is a lot of pent-up downside risk, which has been on borrowed time for such a long time. So I think if in the end it doesn't happen, we do need to evaluate various probability scenarios just in case that this turns out to be the big bear that overall throughout history does happen. History doesn't have to repeat, but there is a rhyme, and that is a pattern rhyme in terms of price and time corrections. And we've seen part of the price correction. We haven't seen the time correction. And to be honest, that's part of the worry. That's part of the concern. So even if we see record highs on a broad-based type markets, not just the NASDAQ, but S&P 500 and the Dow, we do need to see the rest of the world following suit as well. So that would be global leadership and following. And ultimately, we need to have some resolution to a lot of this bubble bursting activity, which has triggered economic and socio-political risks as well.
Okay, let's bring up your next chart here now, and this is another one that we've seen fairly regularly with you. This good, bad, and the ugly. Explain what we need to learn from this in the current context.
Yes, so it's not about being right. There is no certainty in markets. It's all about probabilities. So let's pick up on that point that you asked, Jeremy. What would lead to a reassessment of the bear case? And of course, that would be if we were to trigger a V-shaped recovery and then a move back up to record highs. So if we do see that, it is the first part of this three-part scenario where we compare ourselves potentially to a 1987 V-shaped recovery situation. I believe it's an apples and oranges example, because 87 was actually mid-stage in an 18-year bull market. So it's a very different dynamic to where we are now in terms of the secular long-term trend. But still, the shape of the recovery would be closer to 87. Meantime, we have two other examples, and they're probably more traditional bear market examples. The second one is the U-shaped recovery, which is akin to the global financial crisis of 2008, and then the tech boom bubble crash of 2000. Both markets spanned a price correction of 50 or so percent. So that's an additional 15% from what we saw in March to add on to that. So the second thing is, in terms of time duration, the repair period for the big bear was longer, anything from 1.5 years to 3 years. And this is what a lot of market pundits are missing in the narrative at the moment, where they're looking at the price dynamics and forgetting about time. Markets need time. Remember, people drive markets. And so people need time to recover from the shell shock of what's been happening this year. And that's why bear markets take longer to recover, particularly if you have lots of various divergent signals in place. Last but not least, the ugly chart. This is where we all have to have a very kind of strong cup of coffee before we contemplate this price analog. It's either the 1970s analog, which is actually quite violent roller coaster ride. I always describe this to clients as the mini heart attack in the market, because you've got this kind of up down situation. In some cases, up 70%, down 48%. During that time, it was very different, of course, because we did have hyperinflation, we did have an oil shock, and we did have wars going on at the same time. The 29 crash, I think, is a little bit more closer to the truth, perhaps not in terms of history repeating in exactly the same way, but more so in terms of the price and time analog. We did have a V-shaped recovery, what looked like a V-shaped recovery on face value in the 1929 crash. This is something that I think a lot of historians actually don't know. The first down leg in the 29 crash was down by 49%. We fell short of that. We were 38%, but we did beat the time duration. So we actually fell faster than the 29 early stage crash in 2020. And actually the upside recovery, which was part of a V-shaped recovery back then and now, then was up 51%, now is up slightly higher. Think of it as an elastic band effect. The harder we fall down, the stronger we move up. But in the end, if this V-shaped recovery is false and it creates the next move down, remember that three-stage process, not an event. A bear market correction is a three-stage process traditionally based upon the roadmap that we looked at. Then we're thinking about the full crash, the rally, and the rest of the fall. That third stage of the rest of the fall is the violent 80% down that we saw in the 29 crash. We don't have to see an 89 or 86% move down with lots of violent rebounds along the way. But at the very least, a big bear will equate 50% or more. So anything from 50 to 80% is the average statistical norm, and that will usually take place over a 2 to 3 year period. Again, that would fit the 1929 analog. One additional macro point I'd like to make is during that 2 year period when we went into the 29 bear market, we did have an insolvency situation. So let's look outside of our windows as we're locked in at home just before the economy opens up in some countries of the world, and ask ourselves, look at some of the insolvency issues that are taking place. And that is the shoe ready to drop that I think we haven't yet fully worked out. And with the socio-political unrest also creating a third wave pressure, I think we need to, I don't feel we're out of the woods yet. The charts are suggesting that, and certainly the cycles are adding further risk on the downside in the second half of this year. Let's wait and see what happens as we approach August. That's the peak, seasonality peak on average. Then from August into the election season, that's when we get an average of at least 10% down, particularly if the presidential leader is losing popularity. Of course, we can revisit and reassess between now and then, but certainly that's what the charts and the high probabilities are suggesting right here and now.
I'm fascinated that you bring in the fundamental. I know that when we have our discussions, it's mostly on the technical, but I think it's also important, as you rightly say, to look at some of the fundamental issues that are around. And that chart you showed there, where you had echoes of 1929, I just really wanted to bring in this extra point of discussion about what central banks are doing. We've just had the Bank of England increasing quantitative easing. We are doing extraordinary amounts of support for the markets at the moment. We have seen that in that longest bull run ever in the equity markets between the great financial crisis and where we are now. That was generated in part, I know, because we've heard it said so many times, by the amount of money that's being pumped in by central banks. We've now got extraordinary amounts of help being given, and we're now seeing the Fed buying into the corporate bond markets. They're all obviously looking for better and more improved ways of giving support. Is that, do you think, ever something that ultimately could steer us away from that final chart where we're looking potentially at echoes of 1929 and overlaying them in where we are at the moment? Do you think there's a possibility that fundamentals could ultimately come to our rescue?
Well, certainly these are unprecedented times, and it does kind of give birth to that statement. This time could be different, partly because of the MMT, the amount of central bank intervention. Certainly, the equivalent of QE2, I think, is being spent every week indefinitely, and the central banks, Fed in particular, is, as you quite rightly make the point, now getting involved in various other parts of the economy, some of which are actually experiencing insolvency issues. So I think the jury's out in terms of how that will end. But if history teaches us anything, the value of money is critical. And if people as a society lose trust in the value of money, then they will vote with their feet. And that's what markets and history teach us. So I'm not. I don't subscribe to the idea that central banks can save the day by printing their way out of this crisis. I know it's the moral hazard policy, and I know that it actually helps, at least in the short term. But I think in the long term, we do need to ride this wave down and let certain industries kind of go through the restructuring and that creative destruction opportunity, where we will see industries disappear and new ones replace them. It's that crisis opportunity that takes place in each of these moments in history. Time will tell. I think at the moment, let's not forget that last week, when the Fed actually did announce that they were going to keep rates on hold for the next 2 years, the market sold 1,800 points down on the Dow. So that just shows a little bit of non-surprise happening in the market. And of course, let's not forget the potential future waves of the pandemic just expected ahead around the corner into the autumn season. Add on to the fact the political pressure of the elections coming up. I think we have a few risk factors that need to be weighed on in addition to central bank intervention.
Yeah, look, fascinating, Ron, as ever. And we will look forward to catching up with you again. Of course, we will have a further update from you over the summer, doubtless, as well. And we'll see whether or not the August date that you mentioned there begins to play out, giving us a further insight into how the rest of the year may play out. But in the meantime, Ron, thanks indeed for joining us. That's Ron William from RW Advisory.